So we have an entire structure of asset prices, an entire financial system built on cheap funding or zero cost funding. And so what we're now doing is we have non-zero cost funding. And so the whole edifice is now starting to wobble. Now, whether that completely collapses or whether somehow the plates keep spinning for another few years, I said, frankly, I'm not entirely sure. But we set up Calderwood Capital really with this type of market environment in mind. That was the whole idea behind Calderwood Capital. Our whole kind of thesis was that there was nowhere to preserve wealth. There was nowhere to preserve capital in a world of zero yield or negative yield government bonds. Because remember, everything is priced off government bonds. Everything is priced off government bonds. When government bonds were yielding a negative return, and people were talking about how overvalued equities were and how overvalued credit was, etc., and they were. What they were really saying was expected returns are just super low. You know, a few years ago, I think that a reasonable expected return from equities would have been a real return of maybe 3%, something like that. You know, historically it's been 8%. So you just talked about the UK pension issue as being evidence that something is broken. Actually, there's been a whole bunch of things that are broken this year, and the more niche markets that we follow. I'll give you an example. Some of the things that we're very active in, that we allocate to, cryptocurrency arbitrage has been kind of important for us. Litigation finance, trade finance, mortgage derivatives, reinsurance, default correlation. Other things as well. So we do some kind of funky stuff, and I think we see things kind of from this niche vantage point, maybe a little bit earlier. And so we've seen things breaking, right? So you probably saw some of the cryptocurrency stuff that blew up a few months ago, but that was in one level, that was this crazy thing because it was all cryptocurrency. If you scratch the surface, it was a very, very vanilla example of a banking crisis. That's all it was. You had a bunch of these cryptocurrency firms who were, by the way, were not really cryptocurrency firms in the real technology sense. They were banks, and they were taking deposits, and paying a return on those deposits, which they then invested in assets which they hoped would generate a higher return than the one that they were getting in deposit, which is, as I said, they were banks. And guess what? Paying out 20% a year was actually quite a high hurdle rate. So when the crypto market turned, they couldn't do it and they went bust. So what you actually saw, I think it was the very first evidence that things were breaking, and probably at the most speculative end of the financial system, cryptocurrencies, and it's blown up. So this is what's just recently happened in the UK. But to your point earlier, is something breaking? Was this an example of something breaking? Yes, it was. What do we have? We have another example, another illustration of very, very mismatched liquidity on the assets and liabilities of a balance sheet. And we saw that in crypto. We've just seen it in the UK pension. By the way, we've seen it in the US mortgage market as well, right? If you look at the spread of agencies, again, a little bit esoteric, this is something we follow very closely, something we're involved in, but if you look at the spread of agency bonds to treasuries, we're now at the widest level since Lehman's, right? The widest level since Lehman's. That is distress, right? By the way, 9 months ago, we were at the tightest ever. We were actually on a negative spread, option adjusting. So that shows you how quickly sentiment has spread, right? But you're now getting clear signs of distress in the US mortgage market. Where is the distress? The answer is the mortgage REITs, right? The mortgage REITs who are basically just, leveraging up their agency positions by a factor of 10 and paying it all out as a dividend. Those guys are in a mess. So I think that this UK pension thing, we're seeing it in different places. It's not just in the pension. We're starting to see it all over the place. Well, I think the pieces are in place for a huge correlation event. There's no doubt about that, right? I think that banks are not maybe, as secure as they look, because most of their capital base is in this risk-free asset that's just at its its worst year in 5 decades. It's difficult to see how that's okay, right? Why is that? When you see such a big drawdown, if you're 10x leverage along with government securities, long dated government securities, and they're now all trading meaningfully below par, how come your balance sheet's okay, right? It doesn't make a lot of sense. Now, of course, they'll just say, well, we don't mark that stuff to market because the government securities, they're not going to default. Okay. But that's not the same as saying it's okay. That's just the same. That's what you're saying is that's an accounting trick. And then relatedly, you've still got to fund those assets, right? You've still got a mismatch, right? Where do you fund those assets from? And the answer is deposits. Okay. Well, because I can get, 4% on a money market fund now. Why do I need to put my money in a bank deposit? And the answer is I don't. And so if you start seeing people moving the money out of the banks the banks have got to pay 4.5% for the funding. That's not going to fund the kind of treasury portfolios that they've been building up over the last few decades, right? Which are now yielding significantly below. So it seems that's just one example. There are others, but I think that there's plenty of ways that this can become systemic. I think that the question is, do they actually say, maybe we should stop this tightening and sound a bit less hawkish on inflation?